Hi traders, welcome to Market Outlook, Trends, Risk Events and Trade Setups, brought to you by Vantage Markets. This is a weekly webinar where we focus on the key events and themes, both fundamental and technical, driving markets at the moment. Whilst I just let you have a look at the disclaimer, I'll just run through what we hope to get through in the next 30 to 40 minutes. We'll look at how markets are shaping up currently, obviously very quiet with a lot of markets closed for holiday period today, but then we get into month end and of course some big data points coming up this week. We'll look first at a couple of themes driving markets at the moment. That is essentially now, as we've moved on hopefully from the debt ceiling talks, we moved on now to the shifting higher rate expectations by the Fed. So we'll briefly touch upon that. We'll look at the outperformance of the NASDAQ as well, tech stocks, especially AI associated stocks, really driving that tech index. And stocks generally actually very narrow breadth in the drivers of some of these stock markets indices at the moment. We'll look at technicals on the S&P 500 as we do, the NASDAQ and the Dow as well. We'll then move on to a quick review of last week's main events. Quite a few sort of key data points really. US core PC we got on Friday, Fed minutes last Wednesday, and then we also had UK CPI data that was important for sterling and for the Bank of England especially, and we also briefly touched upon the RBNZ, actually interesting rate decision there or in New Zealand. And we'll look at all the associated majors to do with those events. So we'll touch upon the cable, of course, sterling against the dollar. We'll look at Kiwi dollar, which has fallen to lows, new fresh lows. Before then, moving on to this week's main events, that is, of course, two main events, NFP, so US jobs report on Friday. That's non-farm payroll report, of course. We'll look at dollar yen associated sort of with that, and also obviously this big move higher in that as the yen falls, and we'll look at gold as well if we have time, because that may potentially be moved by obviously the jobs data, and then we'll finish up with the Eurozone inflation data that's out the day before this Thursday, and we'll look at euro against the dollar. So a lot to get through. Generally, markets very quiet, of course, because of this holiday. But the key news over the weekend, of course, the game of chicken, if you like, has come to resolution finally. So the US has averted a major economic crisis by raising its debt ceiling as part of a new 2-year budget agreement that really echoes the structure of the past 3 such deals, actually effectively kicking the can down the road. Again, it was actually the 79th time the debt ceiling's been raised since 1960. It kind of really gives us an idea of how often and how sort of strange in a way these talks go on. They have to go on between the two sides, the Republicans and Democrats. We get a resolution because the US still hasn't defaulted in that time. And really, we kind of should remember that the next time it happens, probably in a couple of years. We said that a few weeks ago. Obviously, it got a lot of press. There was a lot of build-up with this X date at the start of June. And eventually, a lot of seasoned campaigners like ourselves really knew that there would be a resolution, of course, a deal and an agreement. But obviously, we've had a lot of noise in that time, and there are tradable opportunities, so that's not to deny that. Interestingly, I think the draft bill will face a crucial vote in the House of Representatives, followed by the Senate, although McCarthy and Biden have said that's pretty much going to be fine, I think. And then you have the deadline to address the debt ceiling approaching on June the 5th. I think notably as well, the duration of the new limits will extend beyond the upcoming presidential election in November 24. So that really leaves the onus of addressing this matter to the subsequent administration during the first half of 2024. 25. Okay, apart from that, as I say, slow, quiet session in Europe, even though regional markets are open. The US markets are closed, so it's pretty much a long weekend in general for markets across the globe. Certainly, though, once we get back to tomorrow, a lot more liquidity, of course, and then we have month-end trading conditions, which may also exacerbate volatility. That's ahead, of course, then Friday's non-farm payroll. We do get job openings actually on Wednesday, the JOLTS vacancy figures, which have taken more of an important role really in the last few months, of course. And then, as I said, we get Eurozone inflation on Thursday, as well as some Chinese data. Economists anticipating a contraction in their manufacturing PMIs, but continued expansion in non-manufacturing activities, which kind of highlights the picture for most global economies, but certainly the uncertain trajectory of China's economic recovery going forward. Just those couple of themes then, this chart here, which shows Fed expectations. Of course, we said this last week, actually, the big change in markets, and it's continued really over the last 5 days, especially, has been the shift to higher Fed rate expectations to combat inflation, to combat elevated price pressures, instead of the focus that we had on rate cuts amid a possible recession. And if you remember a few weeks ago as well, we did want to highlight this discrepancy again between the market and the Fed saying, generally speakers saying, quite hawkish rhetoric pretty much coming from those officials. And that contrasted with the market obviously pricing in a lot of rate cuts post the US banking crisis. For us, we still kind of think that is definitely a theme to think about probably over the longer term. Tightening credit conditions, tightening lending standards, more regulation potentially coming down the line in the US will crimp activity probably towards the end or the next quarter, which we're heading into, of course, and the fourth quarter as well. Before that, of course, we've had this change in expectations now, and the market then coming around to most of the Fed officials who think that their work is probably not done just yet. And we're now in the process of taking valuations back towards those that prevailed actually just before the Silicon Valley bank collapse. And you can see on this chart really where we are at the moment, Fed funds rate in the orange line. Then you've got the light dark blue line really dotted, the highest showing the higher rates from the Fed dot plot in March. You then had pricing 2 weeks ago, so lots of those rate cuts, as you see, rates sort of maxing out just above 5% and then falling down sort of through this year to sort of 4.25%, 4.5%, 4.25% actually 2 weeks ago. And now you can see where we are sort of slightly pretty much in the red dotted line, and that pricing out of those rate cuts really for this year. There's a few basis points still of rate cuts, but much less than we had 2 weeks ago, before then obviously falling through next year. I will touch upon, actually, just bear with me while we just look at the CME Fed Watch tool. I always like to use this. So this is the Fed funds futures rates on the specific FOMC dates that you can see here. So next meeting, of course, 14th of June of the FOMC, and you can see now a 66% chance of a 25 basis point hike is priced in by Fed funds futures for that meeting in a couple of weeks' time. If we just scroll down, you can see where were we even a month ago, a week ago, only 25% chance of that happening. Now 66% chance of that happening. And then a 1 in 3 chance that we stay where we are, which again was a sort of 3 and 4 chance just a week ago. And then if we look to sort of the end of the year, you can see sort of status quo, 5 to 5.25%, giving above a 36% chance there. That's risen, you can see, from a month ago, which was only a 4% chance. And then we had all these rate cuts priced in. You can see 37% chance that rates would be at 4.5%, so 50 basis points of cuts by the last meeting in December. And then even a 30% chance we got 75 basis point cuts. So you can just see that repricing there, really obvious, and hopefully that's helpful to you guys, and potentially that you use that tool as well, just to reckon as to where Fed funds futures, where traders, money markets think rates are going, which is obviously driving then other markets, the dollar especially. I'm just checking where we are with the 10-year yield, actually, which I'll just show you here. So you can see this big move higher again. I don't want to go too much into sort of these markets, but this is the US Treasury 10-year yield. So not the price, the yield. And you can see where we bobbed around sort of 3.32% a few times. Look, it was decent. Really good support there going back from that low in January. And then we moved consecutively, look, strong gains, consecutive days gains up to now sort of 3.8% nearly. We topped 3.85% there. It's a sort of, this is the global benchmark really for benchmark really for global borrowing, if you like, a proxy for it. And you can see it's just good to track where this is going, then driving the dollar and driving all these other markets as well, which tallies in, of course, with that Fed watch tool. So potentially you've got this high here at 3.9% back from, well, the 30th of December. Actually, you can see potentially a target where people might try to drive these yields. And more closely aligned with interest rates really is the 2-year yield. So this is the US Treasury 2-year yield. Again, look at all those consecutive days of gains. Quite amazing, really. No stopping it at the moment. And we've got above this level here as well, which is again that January high at 4.51%. So we're just above there now. That could have been some resistance, but at the moment we closed above it on Friday, and potentially pushing higher. So you can see if we just pull back, then next levels are sort of around, well, we're beating these levels actually as well, haven't we? So then we're coming up towards, I guess, 4.75% or so. So possibly momentum carrying on, this bullish momentum, but you can see slightly overbought on the daily there. So interesting, just a warning sign potentially. If yields then come back, then the dollar may lose some of its support. And we'll look at the DXY shortly. The other big theme that we wanted to highlight certainly is this outperformance in the NASDAQ in tech stocks, as really this dominance of artificial intelligence in semiconductor stocks, especially IT companies, has really continued. The search and AI-led sectors has fueled investor optimism for sure. It kind of feels like, and I know there are mentions of course, the tech bubble from 2000, and some companies obviously getting massive gains, as well as small companies and even some of the bigger companies, and certainly helped the NASDAQ 100 up 2.6% on Friday, notching a 5-week gain, 5 straight weeks now of gains in the NASDAQ. And if we just pull up the chart, actually, oh, that's the wrong chart. What am I doing? Yep, this is the right chart. So the NASDAQ, just take that off. So you can see the weekly, you can see consecutive weeks of gains. And yeah, just going on, just sort of zooming in on the semiconductors being the key driver. So that ETF has continued its upward trajectory. It leapt 6.5% on Friday. Of course, NVIDIA really driving this momentum and sustaining actually a further 2.5% up on Friday. That's after its 24.4% absolutely massive surge the previous day after it announced, of course, its results, much higher than expected quarterly earnings, and those future sales revenues, which would double what they had been expecting. I think good to just pull up this chart actually. Excuse excuse me, of NVIDIA. If I can find it, which is here, and you can see just parabolic move last week, over 25%. You can see the big gap up after its earnings there, and then we didn't sort of come off that, which is sometimes the case, but we consolidated that really and moved again and closed higher on Friday. And on the weekly, you can see the, as I say, parabolic move higher, very overbought, sorry, on the weekly and on the daily. So interesting to see what kind of pullback or consolidation really we get for NVIDIA, which is driving really the momentum in the index as well. Other stocks as well, Marvell Technology, that witnessed a 32.7% increase as the microchip manufacturer anticipates again explosive revenue growth in the next 2 years, driven of course by soaring demand for generative AI. Broadcom, also another chip maker, semi maker, Broadcom surged 11.5% on Friday. As I say, so a sort of parabolic feel to this, just a straight line up, warns of a pullback, and it'd be interesting, as I say, whether we can consolidate around this. Stock market performance, we've sort of highlighted this in the last few weeks, is very narrow. Only tech is performing, and excluding tech stocks. If you take those out of the S&P, then the S&P is flat, whereas for the year that is. Whereas, of course, it is up around 8 to 9, 10%, I think now. Yeah, above 10%, I'd say, around 10%. I'd have to check. About 9.5%, I guess. Okay, and just let's have a look at some of these technicals then. Always like to start on a weekly. This is the S&P 500, so the broader index. We've been highlighting this area, sort of 4,200. Everybody's been highlighting it, really. So that was sort of strong resistance really from the January peak. You can see 4195, that tallies with that gray line, which is the 100-week moving average. That's now at 4,200. So a sort of zone of resistance around that psychological level as well of 4,200. Bullish consolidation really tracking sideways, quite a long time for us, but last week, or sorry, 2 weeks ago, we pushed up into it and closed just below it, 4191. And then last week, you can see, did look, and we'll look on the daily, did look as though we were turning lower, but you can see a strong close on Friday, near the highs, close at 4205, so above the 4200 level. Really interesting to see now what we do go, whether we can now build on that and push up higher, probably into the next fib level, 4311, and even then this mid-August high at 4325, next target, upside target for bulls, we would say. You can see futures there now, 4222, so pushing above this sort of resistance zone, which would then be a support zone. So really looking at that moving higher if we can consolidate that push on Friday. And you can see there when we rolled over last few days, early sort of started last week, and then Friday really big push higher on the debt ceiling news, and NVIDIA helping as well. As for the NASDAQ, that keeps on going higher. Just to go back to the weekly, we definitely highlighted, hopefully you've been listening, you guys, to this 12,880 even was the key level for us. We stayed above that level, closed above it, tracking sideways, so bullish consolidation before then a move higher in line with a dominant trend, which is for higher prices. So for us, yeah, that was a good, decent trade. We pushed higher. We looked at then the mid-August high at 13,720 as a target for the bulls. We've reached that last week. And we pushed above the 100-week moving average as well. That's at 13,438 now. And then for us, then that sort of 13,720 becomes support. We pushed above that again last week, and we're now up to this fib level, which will be interesting to see how we get on here. Although we did close on the highs, you can see last week at 14,298, and you can see futures pushing higher to 14 sort of 400 near enough, potentially when we open up tomorrow. So 14,349 is that fib level of the 2022 decline, if you like. So it'll be interesting to see what price action is, how it does around there, but certainly strong move, strong bullish momentum, slightly overbought on that daily RSI, and we're getting to overbought status on the weekly, although that doesn't mean we can't move higher, of course. So interesting, especially with non-farm payroll, to see how the NASDAQ reacts. Should just sort of mention the NASDAQ is pushing higher with that other theme that we talked about, which is higher rates. And normally growth companies struggle or are much more sensitive to higher rates in that they would struggle. But at the moment, they're not struggling, but it's being generated, the drivers being generated really by this outperformance in AI stocks, in semi-stocks, semiconductor stocks, and still this narrow breadth. So just something to bear in mind as we go forward. Okay, we'll do a quick recap of last week's main events. Just let me pull up a quick graph chart here. So last week's main events: US core PCE data, that's the Fed's favored inflation gauge. Core PCE deflator, that came in at 0.4%, 4.7%, so higher than the expected 0.3% and 4.6%. You can see that here then falling, as I've said, but still elevated for the Fed. It will be a boost, really, the case of some of the Fed hawks like Bullard, like Kashkari, that really policy needs to move tighter to ensure inflation returns to the Fed's 2% target here. And you can see that is still some way off. Personal income and spending report, that was also a fair bit stronger than expected across the board. Again, fueling talk, fueling markets of another rate hike, and we pushed up, as I've shown you, to above 60% now for that June meeting. Incomes rose 0.4% month on month as expected. Wages and salaries up 0.5%. Month on month, spending rose 0.8% month on month versus the 0.5% consensus, and March was also revised higher. Just talking about this because then real consumer spending, that came in at 0.5% month on month versus 0.3% expected. Inevitably, that leads to upward revisions of second quarter GDP expectations, especially given, if you remember, consumer spending is around 2/3 of economic activity as measured by GDP. Interesting then, next up was the Fed minutes. Quite interesting, really. Didn't really move markets that much, but they showed officials were split on support for more hikes, and participants generally agreed the extent to which further interest rate hikes may be appropriate have become kind of less certain, actually. Many focus on the need to retain optionality after the May meeting. Participants, they generally expressed uncertainty about how much more tightening may be appropriate. Several officials said if the economy evolved along the lines of their outlooks, further policy firming might not be needed. Of course, we've had those hawks talk a lot in recent weeks from the Fed. However, some participants commented that based on their expectations that progress in returning inflation to 2% could continue to be unacceptably slow, then of course we would see additional policy firming, and that would be warranted at further meetings. So a mixture of views. Interesting, I think Powell's last sort of speech said that June he would prefer a pause, but markets now getting ahead of themselves, really, and ahead of him, and pricing in, as we've shown you, that's one more 25 basis point hike. Okay, that's the US. We'll get on to non-farm payroll shortly. We'll look on to UK CPI now, very important data for the Bank of England, for sterling. April CPI was out last Wednesday, plus 0.2% month on month, 8.7% year on year. That's against 0.7% and 8.2% expected, so much higher than expected. 10.1% in March. 7 months, but that's been 7 months. Of course, that was 7 months, sorry, of straight double-digit inflation. Also of concern certainly was the core year-on-year reading for April. That jumped to 6.8% versus 6.2% expected and 6.2% previously. That was actually the highest core reading since March 1992. And you can see it here. So just like in a lot of other regions, the Eurozone, also the US, of course, you've got falling headline inflation because of energy prices falling, because of these base effects taking or having an impact. If you just think 12 months ago where we had the spike in energy prices, that's now fallen out and we get this sharp drop in the headline rate that includes energy prices, food prices, but of course the core inflation rate excludes volatile food and energy, and that is climbing, especially in the UK. You can see there. So as I've said, the headline actually, just to reiterate again, in the UK, that was essentially because of last April's 50% surge in electric and gas prices in the UK. They've now dropped out of comparisons in that year-on-year number, as I've said. By July, actually, when consumer bills are set to fall by roughly 20% in the UK, utilities will be contributing almost nothing to the overall rate. And by October, actually, will be a net drag. So have to bear that in mind when the headline inflation rate comes out next time. Next UK CPI is, just checking the calendar, 21st of June, so a few weeks yet, with the Bank of England meeting out, of course, the next day on June the 22nd. Yeah, big concern though, the core number. Any notion that elevated inflation, of course, is becoming entrenched will certainly disturb the Bank of England policymakers, which, remember, has already lifted rates at its past 12 meetings. Interesting, we have to bear in mind the lagged effect of all of those hikes potentially hitting the economy at some point. But at the moment, inflation is way higher than expected, especially in the UK. Just to note, we did actually get softer PPI data. And also, so that's producer price index, which then feeds into the CPI data eventually, which takes a few months, as I say. And also food inflation is likely to have hit a peak pretty much after supermarkets in the UK announced cuts to milk prices. So this report certainly showed, I think, food inflation rising at around 19% year on year, but services prices, which edged up to 6.9%, and you can see them here from 6.6% prior. They could, this is the issue, could stay high due to sort of PMI services sector prices remaining buoyant. Okay, so all in, this sort of report does add to issues, of course, for the Bank of England and persistent inflation. I've just got the core here, so more clearly, just the core number, stripping out that 31 year highs, highest since March 1992. Yeah, all adds up to sort of the risk of this persistent inflation issue that Governor Bailey's been talking about. He talked about it last week, actually, in front of the House of Commons Treasury Select Committee. He indicated really that inflation was likely to fall actually more gradually to the bank's 2% target than initially envisaged. And there's no doubt, of course, that inflation report that we saw last week confirms really that that theme. Really major headache for the MPC, who will be wary, of course, of raising rates as the economy slows and potentially a sort of harder landing. I think it's coin toss chance of the MPC's central forecast that CPI falls well below target in 2025. Really, that's kind of looking fanciful now. That was what the MPC was hoping for. And the headline, certainly that will fall, but it's all about the core, of course, now, as it is, as we said, in many economies. Just on sort of Bank of England pricing then, we've witnessed a repricing, if you like, in rate expectations. We saw a ramp up in yields, so a sell-off in rates, with markets now discounting I think around 110 basis points of additional hikes by year end. So that would take the bank rate to at least 5.5%. We're currently at 4.5% at the moment. So at least above, or at least 5.5% markets are thinking. For the UK, I know a lot of economists, a lot of analysts see many less hikes than that. And as I said, the lagged effects of the already all that policy tightening we've seen will be balanced, have to be balanced against the obviously core sticky inflation and bringing that down to the bank's target of 2%. Okay, we'll look at cable now. Just bear with me. I'll just pull up the chart. So that's sterling against the dollar. Obviously, this has been very much affected by the dollar side, of course. So you can see where we broke that long-term trend line, or support, really, we were calling it, broke that. And then we've had quite a few consecutive days of declines. We've got two now. We've got a sort of short-term fib level in here. We've got the 100-day moving average at 122.87. And probably above that, you've got 123.08, 123.10, sort of near-term support before we get to that 100-day moving average. If we do carry on with this bearish momentum, upside probably capped by the break level, so around sort of 124, and then you've got the 50-day moving average at 124.35. That's kind of cable. I think, interestingly, we don't pull up some of the crosses, but I will do now, because you could just show, if we take out, obviously, the dollar side of this equation, then say sterling, Aussie, that's getting towards recent highs, you can see there. And then sterling, Kiwi, we're on recent highs, so that's interesting. Let me just pull it back. I've got some thick dotted lines here being long-term sort of resistance levels, spike highs from sort of August 2020, you can see there, and then August 2021, sort of 2.00, 2.0270. So yeah, we're above those, and we're near these highs from February 2022. And if I just pull back, yeah, there's sort of, we've been range trading, really. So in a way, we should be pushing up if we can, or whether then this resistance caps the upside again and we fall back into the range. Interesting point, really, for sterling. Kiwi, don't look at that much, but we thought some interesting levels, technical levels here. We've also got sterling yen, which is now pushed above those highs from October 2022. You can see we just pulled back today, but strong weekly close near the highs last week. Just look on the daily, you can see oscillating around that previous sort of mark from, where is it, October 2022 at 172.12, and then we pushed higher above it on Friday. Strong close. So as long as that holds around 172 level, then we should be looking at higher prices, really, for us in sterling against the yen. That's a sort of monthly chart, just looking at upside levels. Okay, so certainly sterling strength against or in some of the other crosses. PMIs, I'll just go on to those briefly. As I mentioned, actually, before, UK, Europe, and US, similar to that China expectations for this week, manufacturing sectors are under intensifying pressure, whereas the all-important, at least in those UK, European, and US economies, all-important services economies are booming, really, doing very well. Eurozone PMI, that kind of delivered mixed results. French services was weaker, German services stronger than expected, and then manufacturing both soft. So then the overall results for the Eurozone reflected broadly weaker than expected activity in both actually services and manufacturing. But the composite reading, 53.3 against 54.1 in April, kind of still suggests positive momentum. It's above that 50 boom bust line, of course, and services sector inflation, which is important, does remain still elevated. Okay, RBNZ, very quickly, if we go to, we'll go to actually a graphic. If you do have any questions, of course, I should say, then please do ask them in the chat function, the chat box. Always very happy to answer any questions you have on the setups that you see, on the setups we're looking at, because we only really concentrate on the majors, but obviously just dipped into some crosses there as well, and any of this technical, fundamental stuff that you need explaining or just looking at yourselves, and we can look at it and give a view as well. Okay, just moving on to the RBNZ, as I said. Just losing track, sorry. So we've got this graphic here. You can see very aggressive policy tightening by the RBNZ. They raise rates as expected to 5.5%. So that's the highest in advanced nations, actually. But markets clearly saw this as a sort of dovish hike. The committee discussed the option of leaving the policy rate unchanged at 5.25%, and the decision to hike by 25 basis points was a close one, actually, with a 5-2 vote split. Rate projections signal as well. We had updated ones from the RBNZ, and the kicker really was they see this as a peak of the tightening cycle in New Zealand, and that rate cuts are possible from the second half of next year. So where markets were expecting pricing in actually another 25 basis point hike after this one, then that was completely pushed against by the RBNZ with their new rate forecasts. Of course, the hike had been seen because of the recent spending boost by the government. We also had upward revisions in growth forecasts and rising migration, as I said, had led many economists to expect the RBNZ to signal more hikes in those new rate projections. Yes, the RBNZ deemed the impact of rising net migration on inflation as uncertain. The focus really on the evidence of a slowing economy, the impact of already restricted monetary policy, which is kind of what I've said with this lagged effects, a struggling housing market, and lower than expected CPI figures. And the sort of government spending, which was meant to be a kicker to the economy, is likely to be spread over more than a year. So that was kind of the reasoning from the RBNZ. I'll just show you obviously, you probably saw the Kiwi dollar completely and utterly collapse, down over 2% after that. The surprise shock, really, dovish hike, dovish forecasts. And we carried on pushing lower, actually, in Kiwi against the dollar. Again, bear in mind the dollar side of that, working against that pair. And we pushed below, of course, the year-to-date lows from March at spot 60.84. So interesting, really, where we go from here. As long as we consolidate below that sort of level, then potentially we push down to we've got this level of support you can see here from July 2022 at 60.60. So that'll be interesting whether this holds up prices as well around here. And you just see we've got a small bid today. Okay, moving on to this week. Finally, let's move straight to non-farm payrolls. We've got the usual graphic here. Hopefully this helps of all the main numbers which are expected. Key marquee event of the week, certainly. Consensus looking for a softer figure. Around 175,000 or so in May. That's jobs added. That's against the 253,000 seen last month, so which surpassed consensus estimates. But this was also set against downwardly revised figures for March at 165,000 from the prior 236,000. Interesting, a lot of people mentioning about how many times and consecutive times the headline beats the economists or the sort of consensus estimates. 13 straight beats now are on, so economists consistently underestimating the strength of the labour markets. But again, we always watch those revisions because they pull down the headline a month later. Unemployment, that is seen nudging up to 3.5% from that multi-decade low of 3.4% that was seen in January, as well as last month, and then not for decades, not since 1969, I think. And then we've got this all-important average hourly earnings, so wage growth for the month, seen up by 0.4% after the 0.5% previously. And really, yes, normally there's a lot of focus on the headline data, but certainly last month in April, the standout figures were the decline in the unemployment rate to 3.4%, and then that re-acceleration in average hourly wage growth that gained the most attention, really, given the implications for monetary policy and considering, of course, the high inflation backdrop. That April move higher in average hourly earnings certainly would have concerned the Fed as it tries to encourage inflation back towards a 2% target, especially now that rates are at levels where some kind of pause is very close, if not very soon. Yeah. As such, certainly there will be a lot of attention paid to those average hourly earnings figures, really to figure out if April's plus 0.5% monthly print was a one-off or in fact a step higher in the trend. If you think about it, without a rise in productivity, which could sustain higher wage numbers, then the Fed will certainly hope for an easing in wage growth to return inflation to target. All in, then the non-farm payroll report will guide that decision, with the wage numbers an important part alongside the general tone. And you just see, I've just reiterated that sort of chances of a 25 basis point hike above now, definitely above a coin toss, 64% at the moment. And it'd be really interesting to see how we get on, obviously, with the non-farm payroll report. I said we'd look at just quickly look at dollar yen. That'll be impacted because the yen or this pair is certainly driven by interest rate yields. The 10-year treasury yield is a big driver of dollar yen, and then interest rate differentials, so just the difference between the 10-year JGB, the Japanese government bond, and of course the US Treasury. That's pushed up this pair to above 140. You can see really strong move higher. We thought there would be some resistance. Oops, excuse me. We thought there would be some resistance around this level, the March high around 137.91. There, sort of, we pushed above it and then consolidated. Really, it's a bullish consolidation, nice sort of continuation pattern there before then a move in line with this dominant bullish trend. Up to then where we've got sort of big fib levels here. The 50% move of the decline from the 151.94 high. That halfway point is at 139.58, so we've closed above there. The next fib level, 142.49 potentially. Otherwise, we push back here below 130, sort of 958 down to, then we see, well, the breakout level would be around 138.80. That is dollar yen. Okay, just before finally we look at Eurozone inflation data, we'll look at gold as well, because that will be pushed around by non-farm payrolls for sure. I'll just show you, yeah, this is the gold chart. So currently resting on, you can see sort of really interesting levels here. We've just put in some short-term fib levels, and the halfway point of sort of the rally from February up to 2067 in May 2067, that high. So the halfway point is at 1935, which we're just sort of above now and holding above for the time being. We've also got the 100-day moving average at 1935. So big sort of support level there potentially. Also, if we just pull out, you can see I've got this sort of long-term ascending bull channel, if you like, which we've been oscillating amongst. Forget the one there because we broke down. That was a shorter term bull channel, wider, longer term bull channel there, and we're at that bottom of that range. So really you'd expect some sort of decent bounce, really, if this acts as strong support. I think another day like today, potentially looks like consolidation before then a real attack on that 1935 level. Really be interesting with non-farm payrolls coming up, of course. Just fundamentally on gold, really, just should mention, of course, debt ceiling deal. That's obviously supporting positive risk sentiment and then lessening demand for safe haven assets like gold. And then, of course, we had that hot PCE data on Friday, the inflation US data, pushing those June rate hike expectations up. And that really doesn't help gold being a non-yielder, of course. Upside then we'd need to see probably above getting towards, really, you'd think above 1992. That's the 50-day moving average, which is sort of above this consolidation zone here before we had that break lower. We've also got 1959 as probably near-term initial resistance. Okay, just finally we'll look at Eurozone CPI data. Sorry, I thought I had a graphic, but I haven't put it in there. Apologies. So yeah, Eurozone flash data, inflation data for May, that released on Thursday from the Eurozone. Headline rate is seen dropping from 7% to 6.4% year on year due to those lower energy prices, base effects, as I've said already. Core rate is seen budging only marginally. So consensus penciling 5.5% after 5.6% year on year for April. And that's really an increase in services inflation balances out a decline in goods, core goods inflation. The core measure, as I've said, excludes food and energy, so will be the one to watch. Certainly it's the one the ECB watch. And given that it's been stuck around sort of 5.6, 5.7% for the last 3 months, this will be concerning the Governing Council, likely to be a key feature of also the ECB minutes account, which is also released on Thursday. We've had various speakers, we should say, ECB speakers over the last few weeks, even the last week, kind of talking about this high inflation issue. Of course, hawks definitely all over it. Underlying inflation, there's no sign of underlying inflation abating. ECB will hold rates at their peak for a significant time, and adding that they need to increase rates, 25 basis points in both June and July. And I think he's a ECB hawk, very open-minded again about a move higher in September. Villeroy recently suggested rate hikes might be in play over the next 3 meetings, while there were other speakers. Chief Economist Lane highlighted there is no sense of certainty in the terminal rate and added that uncertainty in the models is high. Not a lot of the use there, but yeah, just contrasting views still, but generally looking for a couple of more rate hikes. Yeah, pricing wise, 2 further hikes then taking rates just below, I think now currently just below 3.75% there, 3.7% seen as the peak rate in European rates. Before the Silicon Valley Bank collapse and crisis, I think rates peaked just around 4%. So we're not there yet. We're not back to that sort of level, but certainly pushed higher from what we've seen in over the last few weeks. Okay, just on Eurodollar again, I think I mentioned this. We had stretched long Eurodollar positioning coming into the debt ceiling negotiation period. So that kind of meant the pair was vulnerable to corrections. And that's what we've seen. You can see breaking that long-term trend line, similar to cable, and then rolling over and moving lower again. So quite a few consecutive days of declines. We're just about holding 107.16, sort of 107 psychological level really as well. So that's a support zone, but potentially we probably lose these 2 lows at 107.01, 107.07. Just call it 107 around that zone. Then potentially if we lose that, we're looking to move down, and that could pave the way towards sort of, where are we? This level here, sort of 106.50 or so. That's euro dollar. Big drivers, of course. So then inflation data on Thursday, and then of course non-farm payrolls on Friday. Okay, please do follow us on social media. And also we print a daily commentary piece on the website, which includes a chart of the day and a look at the day ahead generally, or some market thoughts. Hope that proves of use. Hopefully this webinar is proving useful to you guys. Great to see you on here, and we will speak to you next week. Okay, take care out there.